All right, so here we are at chapter 5, and this is the first chapter of our corporate operations section. And so our corporate operations section goes chapters 5 through 8. And I'm going to break these chapter 5 videos up into several small videos. So this is going to be part 1, and I'm not exactly sure how many parts there will be, but I'm going to do a couple of discussion slides and then a couple of the problems, and then I'll cut and do another video. That way you can digest these in smaller snippets. All right, so here we go. All right, so this slide is just a kind of a comparison, as you can see, of the corporate and individual tax formulas, okay? And the big thing to notice is that the corporate tax formula is really much simpler than the individual tax formula. Notice that in the corporate tax formula, we have just one bucket of generalized deductions as opposed to all of our different types of deductions, okay? But the way the formula is constructed is very similar, right? We start with gross income, we have some deductions, we go to taxable income, then we have our tax rate. That's the easiest part of the whole situation. Then we come up with our regular income tax liability. We have a variety of other taxes, payroll taxes, for example. You get your total tax, and then you have your tax credits, okay? And there are a variety of business tax credits, just like there are a variety of individual tax credits. Right, so the first topic in chapter 5 that we really spend a lot of time on are book tax differences, okay? And remember that book tax differences arise because we start with financial accounting income often, okay? And then we have to go from financial accounting income to taxable income, okay? And so these book tax adjustments, they simply get us from financial accounting treatment to tax treatment, which is oftentimes very different. Now, it is important to realize that if you have a company that's preparing their financial statements with tax accounting methods, as some small companies do, then you don't have book tax differences, okay? So what are our general types of book tax differences? I'm going to move that over there. Okay, so we have, generally speaking, unfavorable book tax differences, okay? What does an unfavorable book tax difference mean? It just means that it is an adjustment that makes taxable income larger than book income, okay? And what is an example of that? An unfavorable an unfavorable book tax difference. Well, an unfavorable book tax difference would be fines and penalties. And the reason that would be unfavorable is because fines and penalties are deductible for book purposes, but they are not deductible for tax purposes. Therefore, that difference, you're going to end up with a larger amount of taxable income relative to book income if you have a lot of fines and penalties, all right? Now, you also have, of course, favorable book tax differences. And what that means then is taxable income is less than book income, all right? And a great example of this is municipal bond interest, All right. And why is municipal bond interest a favorable book tax difference? Well, municipal bond interest is not taxable, but it does count as income for book purposes. So it's included in financial accounting income, not included in taxable income. Therefore, it is favorable. Okay. Now, we also have two other distinctions. We have permanent book tax differences. Okay. Permanent book tax differences never reverse. All right. So once that difference is there, it's always there. And incidentally, municipal bond interest is an example of a permanent book tax difference. All right. Also, you have temporary book tax differences. All right. Book tax difference, temporary, book tax differences reverse over time. All right. And so what is a great example of this is depreciation. All right. And why is it a temporary difference? Well, remember that we have maker's depreciation for tax purposes, and then you have whatever systematic and rational method you choose for financial accounting purposes. So then you're recovering those costs at different rates. Okay. Well, that cost recovery is going to reverse over time, because eventually you're either going to fully depreciate that asset or you're going to sell it. And so that is a temporary book tax difference. Now, there's a huge list of common book tax differences. And I will load those into a Word document and post it just so you can see it's a laundry list essentially of favorable and unfavorable, permanent and temporary book tax differences. All right, so now we come to our first question. So which of the following does not create a permanent book tax difference? All right, so we have all of these things. We have organizational, and startup expenses. We have key employee death benefit income. We have fines and penalties expense, and we have municipal bond interest income. Okay, so this question is asking us which does not create a permanent book tax difference. Okay, so let's look at these. All right, so we know municipal bond interest is a permanent. Okay, so this is permanent. All right, fines and penalties. Are fines and penalties ever going to be deductible from a tax perspective? No. So this is also a permanent. All right. Key employee death benefit income. So this would be from a key employee life insurance policy. And these key employee life insurance policies are not taxable. So this is also a permanent source. And what do we know about organizational and startup expenses? Well, what we know about organizational and startup expenses is these are amortized. For tax purposes. But for book, they're expensed immediately. All right. So this is an example of a temporary book tax difference. Okay. And would it be and I know the question doesn't ask this, but would it be favorable or unfavorable? This would be initially an unfavorable book tax difference, because if you're amortizing something, you're getting to recognize a small little piece of the cost recovery as opposed to it being completely expensed for book purposes. Okay. Now, down the road, once you get to recognize the rest of that cost recovery, then that that unfavorable will reverse because, again, it's temporary in nature. All right? All right, next question. Which one of the following does not create a temporary book tax difference? Okay, so which one is not temporary? Okay, so in other words, which one is permanent? Well, what do we know? We know depreciation expense is the most common temporary. Okay, bad debt expense. Well, what happens, hopefully, to bad debt expenses? They get collected. So that is also temporary. Deferred compensation. What is deferred compensation? Deferred compensation is compensation that I'm going to earn later, right? It's something that's being paid, or I will be paid later. So that is temporary in nature. This dividends received deduction, okay? So this dividends received deduction is permanent, all right? It is a tax deduction only. Therefore, it is the source of a permanent and favorable book tax difference. Okay, so I'm going to have to make this one a little bit smaller, and then evidently the options got cut out here, but we can still work through that. So Amstor Incorporated sold some of its heavy machinery at a gain, and it used the straight line method for financial accounting depreciation and immediate expensing for tax cost recovery. Okay, so let's just pause a minute. Immediate expensing for tax cost recovery. So what is that code for? Well, that's code for it either got to use bonus depreciation or Section 179, okay? If accumulated depreciation for financial accounting purposes is less than accumulated depreciation for tax reporting purposes, what is the nature of the book tax difference associated with the gain on the sale, okay? So essentially what we're trying to do is decide, is this a permanent or temporary? So is it perm or temp? And is it favorable or unfavorable? Okay, so let's take a look. So when I have a problem like this, I like to put numbers to it, because to me it makes more sense if I can see some numbers. So we know that we've got financial accumulated depreciation, all right? And we are told that for financial accounting purposes, accumulated depreciation is less than for tax reporting purposes, okay? So we're going to let our financial accounting depreciation be $1,000. We're going to have our tax accumulated depreciation be $2,000, okay? And we're then asked, what is the nature of the book tax difference associated with the gain on the sale? Okay. And so we'll say that our cost of the thing was $2,000. So what is our basis now? So hold on, I'm going to switch colors so this doesn't get so cluttered, hopefully. So our financial accounting basis then, if our accumulated depreciation was 1,000 and our cost was 2,000, then our financial accounting basis is 1,000. And our tax basis, well, We know that we immediately expensed the thing. Our cost was $2,000. Our tax accumulated depreciation was $2,000. So our tax basis is 0. All right? So if we sell this thing for $3,000, right, then our financial accounting gain is $2,000. Our tax gain, because our basis was 0, oops, that should be 3,000, is $3,000. All right. So what does that mean? That means that our book tax difference is going to be an unfavorable book tax difference. And since it's a result of depreciation, it is going to be a temporary book tax difference. So to recap, our book tax difference is going to be unfavorable because our tax gain is $3,000 and our financial accounting gain is only $2,000. All right, so our book tax difference is unfavorable. It's temporary because it's due to differences in this accumulated depreciation. Okay, so I'm going to stop the video here and post this one and then start on the next slide for the next video.